Hi everyone, this is Craig, the options linebacker, and this is the weekend report for Sunday, December 20th. I'm going to start off today with the SPX daily chart. It's been stuck in a 30-point range for over a month now. This is astonishing. Now what this means is the Bollinger Bands on the daily chart have pulled into less than a 30-point range. It's been 4 years since we've seen a move like that. Now what do we know about Bollinger Band squeezes when they happen like this? Well, usually they will feature an explosive move out of the squeeze. And the analogy I always use is using a wet orange pit that you've got between your fingers, and you're squeezing hard on that orange pit, and you know it's going to go flying out of there with some distance. You just don't know which way it's going to go, because many times that initial move out of the squeeze is not the final move. Let's go take a look at one from 4 years ago. Here's the S&P 500 chart 4 years ago. So this is 2005, December 2005. After a strong rally off of the bottom starting in October going through November, the S&P went sideways for over a month and created a Bollinger Band squeeze that was less than 30 points. It was about 20 points of a squeeze. And you can see that what happened is the S&P tried to break down first. It actually did close below the Bollinger Bands. So that was the initial move right here. But that was not the correct and final move. The correct and final move was a strong short squeeze higher, which actually pushed the price well above the Bollinger Bands. Now ultimately it just didn't go anywhere, and the price continued to go sideways for a number of months, sideways to up. So I think looking at today's price action, we'll have something very similar to that. Either we'll have a move to the bottom, which gets everybody bearish, and then you'll see a sharp move higher from there, or the opposite of that. You'll see the price jump up probably above S&P 1121 to pull everybody into the fact of thinking that, okay, here goes the market. We're jumping above heavy resistance at the bear market 50% fib, and then you'll see a lot of people taking profits. So especially in a light trading environment that we're going to see over the next 2 weeks, as more and more institutions pull back from the market and wait until the first week of January to see what direction they're going to lick their finger and stick it up in the wind and see which way it's going to go. I think the volatility may be somewhat treacherous here in the next 2 weeks. On a light market, it can get easily pushed around into the wrong way. Remember, the market's job is to push as many people to one side of the boat and then swing the boom over and cast them into the water. So from now until the first week of January, this is a good time to be in the majority of a cash position. Now the Russell 2000 interests me. We've had a massive 80% rally off the bottom since March in the Russell, and then what we saw through the months of October and November is a change of polarity. It actually started making lower highs and lower lows. Well, that all changed at the end of November as we put in a higher low on the hammer candlestick. So this shows that the polarity most likely has changed to the upside now, as we're seeing the initial wave up off the bottom, the pullback wave, and now here comes wave 3, which is the most powerful wave. Now, the Russell has got some overhead obstacles here. First of all is 625 right around here, and then above that we have about the 650 level on the Russell. Let me show you why that's so important. All right, here's the Russell weekly chart, and starting in 2008 right here, the Russell stayed in this range through about 75% of the year. And look at how well that 650 level held up on the Russell. Now when it dropped, it fell down through there like a stone and it was gone. So what was once great support, tested 3 times and then finally fell through, should be strong resistance going forward. So we'll also see the same thing coming back the other side. On the Russell chart, presently there's resistance at about 625, and then of course this resistance up here at 650. So once we drop through there, what I was saying a year ago was saying, hey, I can't wait till the price gets back up to here, because what I'll be doing is selling bear call spreads up in this level. So I'm looking forward to doing that, starting with the February cycle, which will be starting our offense with that in the next week or two here. Now we just closed down our December positions, and we tallied it yet another profitable month, the 4th in a row, and the 10th out of 12 for 2009. So we've been very, very consistent making a profit so far this year, and we intend to do the same thing going forward. So this is a delta neutral position P&L graph, and what you'll notice about this is that we're risking the same amount that we're looking to profit on. So this is a 1-to-1 risk-reward ratio trade. So what you have to pay for that is that the strikes are somewhat narrower. So these are 30 delta strikes that we're looking at selling, both on the bottom side and the top side for that. Now the price is right here on the Iron Condor, and you can see that this is right now very close to the maximum profit that's currently offered for this trade. Now, we've already taken off 50% of the position for a profit, so what I'm trying to do is manage my risk going forward. Remember what I talked about at the very beginning of this video, that we're expecting a big move. Could be the wrong direction for the initial move, but we are expecting a big move sometime here within the next couple of weeks. So what I'll be looking to do is, as we burn some more time value off of this position and the profit curve starts to increase, I'll look to completely shut this trade down by the end of this calendar year. And that's it for the locker room this week, folks. Have a great holiday week.